Somewhere right now, someone with the exact same salary as you is quietly building a stock portfolio that could be worth 10 times more than yours in 20 years. Not because they picked some secret stock nobody's heard of. Not because they got lucky. Because they understood something most people investing in 2026 completely ignore. I'm not talking about meme stocks or crypto or the next thing your cousin saw on TikTok. I'm talking about the actual sectors and companies analysts are watching heading into 2026. And more importantly, the pattern behind why they're watching them. After going through what's driving markets right now, I pulled together the picture that matters most. If you only remember one thing from this video, make it the last point. It's the one most backwards, and it's the one that actually determines whether you make money or lose it. Let's get into it. Point 1. AI is still the story, but it's not the story most people think it is. Everyone knows Nvidia by now. It's not a secret anymore, and that's exactly the problem with treating it like one. Nvidia currently controls an estimated 80 to 85% of the AI chip market. Global AI investment is projected to grow from around $340 billion in 2025 to something in the range of $3 trillion by 2035. That's not a typo. That's the kind of growth curve that reshapes entire industries. But here's what almost nobody says out loud. Buying Nvidia in 2026 isn't the contrarian move anymore. It's the obvious one. Everybody already knows. The real opportunity in AI right now isn't the chip everyone's heard of. It's the bottlenecks underneath it that nobody talks about at dinner parties. Point 2. The AI bottleneck stocks. Every AI data center needs three things nobody thinks about when they picture artificial intelligence: power, memory, and cooling. Companies solving those unglamorous problems are seeing serious momentum. One company supplying power infrastructure to data centers has landed long-term contracts, including a 10-year agreement with a major tech platform. Another, focused on the connectivity technology that helps data move efficiently inside AI computing clusters, posted revenue growth of roughly 93% year-over-year in the most recent quarter. Notice the pattern. Nobody's excited about power lines and cooling systems. That's exactly why the returns are still available there instead of already priced in. Point 3. The Magnificent Seven aren't done, but they're not equal anymore. Amazon's continued investment in AI and automation is expected to keep driving performance through the year. Meta's advertising business, combined with long-term bets on AI and the metaverse, has analysts projecting continued strength. And a major memory chip maker has been surging on the back of the AI memory boom, specifically the high-bandwidth memory needed to run AI data centers at scale. These aren't identical bets. Amazon is a logistics and cloud story wearing an AI costume. Meta is an advertising machine funding a long-term experiment. The mistake people make is treating big tech as one basket. Each of these companies is really a different bet wearing the same market cap size. Point 4. The market's overall direction is more optimistic than uncertain, but the range matters. Analyst price targets for the S&P 500 in 2026 aren't identical, and that spread tells you something important. One well-known market strategist has projected the index could reach 8,250. Morgan Stanley's target sits at 8,000, implying growth of close to 17%. Goldman Sachs is more conservative, projecting 7,600. Notice none of these are pessimistic, but notice also they don't agree with each other. And the S&P 500 itself is heavily concentrated. The top 30 companies make up more than half the index. That means when people say the market is up, what they often mean is a small handful of enormous companies are up, and the rest of the index is riding on their coattails. Point 5. Undervalued doesn't mean unpopular for no reason. Away from the AI headlines, there's a separate conversation happening about value. Small value stocks are currently trading at a noticeable discount to their estimated fair value. Some analysis puts that gap at over 20%. Healthcare has actually underperformed the broader market this year, and analysts are flagging specific opportunities in biopharma, medical devices, and distribution companies within that sector. Industrials, on the other hand, have outperformed, with particular strength called out in farm machinery, aerospace and defense, and construction-related companies. Real estate is also outperforming the broader market this year while still trading below fair value estimates, helped along by improving income growth in the sector. None of these are as exciting to talk about as AI. That's precisely why they're worth paying attention to. Point 6. Defensive stocks matter more than people admit when they're excited about growth. Earlier in the year, consumer sentiment took a real hit. One closely watched survey showed a double-digit percentage drop tied partly to geopolitical tension and rising gas prices. In moments like that, defensive dividend-paying companies with steady, non-negotiable demand tend to hold up better than growth names.
Because dividends provide liquidity and a return even when prices aren't climbing, and steady demand protects against a slowdown in consumer spending.
This is the boring half of investing that never trends on social media, and it's exactly the half that keeps a portfolio standing when the exciting half gets shaky. Point 7. Recent performance is not the same thing as future performance. And this is where most people get it wrong. It's tempting to look at a list of the best performing stocks over the last year and assume the pattern continues.
Analysts openly admit that predicting which current top performers keep performing is something even professionals haven't mastered.
A stock that's up sharply over the past 12 months might have already priced in everything good that's likely to happen to it.
The people who lose money in markets like this one aren't usually the ones who pick a bad company.
They're the ones who buy a good company at the exact moment its story has already been told to everyone else. Point 8, the one I told you to remember. Your portfolio isn't supposed to look like anyone else's.
Here's what almost every list like this gets wrong by omission.
The best stocks for 2026 genuinely depend on who's asking. A younger investor with decades until retirement and a long runway to recover from volatility is in a completely different position than someone 5 years from retiring who needs stability and income now. Analysts openly acknowledge this too. The best performing stock in the market isn't automatically the best stock for your specific portfolio, your specific timeline, or your specific tolerance for watching a number drop 20% in a bad month. I want to pause here, because I know some of you are thinking this sounds like a cop-out,
and it depends answer. But think about it the other way.
If there really were one universal answer, one stock or one sector that was simply correct for everyone regardless of age, income, timeline, or goals, then every professional fund manager, every analyst at every major bank, and every retail investor would already be doing the exact same thing. And there'd be no market left to profit from, because everyone would already own the same handful of winners.
The actual skill in investing isn't finding the secret stock nobody else has heard of.
It's understanding which of these themes, the AI infrastructure story, the undervalued sectors, the defensive plays, the concentrated megacap growth actually fits the amount of risk you can stomach and the number of years you have before you need the money. Someone in their late 20s chasing AI infrastructure names and riding out volatility for 15 years is making a completely reasonable decision. Someone 5 years from retirement making that same bet is taking on a risk that doesn't match their timeline, no matter how good the headline growth numbers look.
I think about two people with almost identical starting points here.
Both around the same age, both putting the same amount of money into the market each month. One of them spends hours every week chasing whichever stock is trending that day, jumping into whatever's up 15% this month, selling in a panic the moment it dips, chasing the next headline. 3 years later, his portfolio has moved sideways despite putting in real effort and real attention, because he kept buying the story after it was already priced in and selling the moment fear set in. The other one picked a mix that actually matched his timeline, some exposure to the AI infrastructure theme, some in undervalued sectors, some in steady dividend payers, and added to it automatically every single month without checking the news.
He didn't feel smart doing it.
There was no dinner party story in I have a diversified position I don't check daily. 3 years later, his portfolio isn't dramatic, but it's meaningfully ahead, because he wasn't paying the emotional tax of constantly reacting to whatever was loud that week.
That's really the difference underneath every single point in this video.
It was never about knowing which specific stock wins in 2026. Plenty of people already know the general themes: AI, infrastructure, undervalued sectors, defensive plays, and still lose money, because they apply all of it the same way regardless of their own situation.
The people who actually build wealth in markets aren't the ones with the best information.
Information about Nvidia's market share and the S&P 500's concentration is available to literally anyone with an internet connection right now. The people who build wealth are the ones who take that same information and match it honestly to their own timeline, instead of copying whatever a headline told them to buy this month.
The market in 2026 isn't asking you to be clever.
It's asking you to be honest about who you actually are as an investor, and to stop borrowing someone else's strategy just because it sounded confident on a thumbnail.